All right, so we're going live here. I am waiting to get onto Instagram Live. As soon as I get on Instagram Live and I see a few people online, I'm going to go ahead and get started. What we're going to talk about today is the difference in speed. The difference in speed. Why is there a difference when markets are rising and when markets are falling? Why is there such a difference in the speed of those markets? So, what you have to talk about if you're going to talk about the speed of a market at which it either rises or falling, it falls in prices. What you have to talk about first is what the structure of the market is itself, because when we talk about the market a lot and when we talk about investing, and there's a lot of ways you can invest. You can invest in currencies, commodities, stocks, ETFs, mutual funds. There's a lot of different ways that you can be an investor. And what I discuss a lot is the emotion that is behind the way markets move. Because if you're honest with yourself, and if anyone is honest with themselves, the market is based on people. It's plain and simple. It's based on people, human beings. And there's a few different players in the markets, and I talk about that quite a bit. You have your market makers; those are the people that create the transactions. They create the buy side and the sell side. Then you have your next kind of level of investor, and that is your banks, brokerages, hedge funds, CTAs, wealth advisors, these guys. And then you have that final layer, which we will call retail investors. And by retail investors, all we really mean is the average everyday guy, the guy that has a 401k, an IRA. There's some self-directed traders out there. Anybody with Robinhood, all you guys with Robinhood, you're all part of retail. Schwab, E-Trade, any of those discount firms, you're all part of retail. And everybody plays their own role. Okay. And we've been through the roles of those different players several times. So I don't want to reiterate it in this broadcast. I want to talk about what I came here for, which is why do rising markets seem to take so much longer than falling markets? Why is there such a speed differential? And I'm going to keep it really simple for you. The reason that there is such a difference in speed of a rising market versus a falling market is very simple. It's market structure. So let's talk about market structure very quickly before we get into the actual. And you have to talk about market structure if you're going to talk about speed, because that structure is what creates the speed. So everyone, or most of you, let me see how many of you do in fact know that markets rise 80% of the time and markets fall 20%, 25%. So 80 basically of rising versus falling. And that's why being a bull in a market, being a supporter of the market, being a buyer of the market is advantageous, or at least it appears so. So it appears to be advantageous because you say, well, 80% of the time, if the market's rising and 20% of the time the market is falling, then it obviously you want to be a buyer of the market. Well, it's not that you're wrong, but there's another component to that. It's not just how long does it take for a market to rise or how long does a market rise. It's also to what degree. So how much money. So when prices are going up, do they tend to go up very fast or do they tend to go up a bit slower? Well, that depends. That depends on that middle group, those banks, brokerages, hedge funds. Are they buying or are they selling? Because their job is to be consistently buying and selling in these markets. So because they have to profit. That's what their trading desks are. Okay. So their trading desks basically profit the firm by buying and selling stocks. And that's what creates the ebbs and flows. And when I say stocks, you have to remember, I'm talking about currencies. I'm talking about commodities. I'm talking about all different investments. I'm saying stocks because it's easier. Most people know what that is and understand what that is. But if they're buyers of those positions, then and they're not trying to get people excited yet, then it's sort of the market just sort of drifts up, right? And that's why 80% of the time markets go up, because 80% of the time they're buyers. Now, the other 20%, when they start to sell their positions to retail, that's just the average investor. When they start to sell off their stocks to retail so that their trading desk can make a profit, which is the goal of the trading desk. That is one of the main functions of these institutions, is to profit by buying and selling different investments. So when they begin selling, and they're selling it to retail, they're selling it to the average everyday guy, prices will fall very quickly. Why? Let's talk about it. So in my mind, there are two reasons that markets rise a bit slower, two primary reasons that markets tend to rise a bit slower than they tend to fall. So when a market's rising, let's talk about it. There's the emotional part of buying and selling. So you have some emotions there. And then there's the structural part. So how does the market actually work? Excuse me. How does the market actually work? Because that's the structural component. So let's talk about how it works. So when a stock comes out, it's an IPO, right? It just hits the market. Who brings it to market? Banks and brokerages, which are effectively kind of the same. I mean, banks, brokerages, it's all the same thing at this point. It's all meshed together at this point, minus a couple of players. It's pretty much all meshed together. So these they come in, and this stock, this position, this security comes to market, and they start buying it little pieces at a time, So they're not buying a ton of shares. They're building a position. They're scaling into a position of a stock, okay? Or they're scaling into a position of a currency, or they're scaling into a commodity. You understand, whatever security it is, they're starting to buy some. What that does is that starts to create levels. Every time they buy, they basically create, if you imagine steps, they're creating another step. That step is a support level that's very difficult to break through. So what happens is if price goes from $5 to $10, they purchased, 200,000 shares at $10. They've created a step. They've created a support level that price has a very, very difficult time getting through. And in fact, the only way price is going to get through those levels is if someone bigger, or a bigger order, comes in and is selling that position. So they're driving prices down harder than these institutions are buying. So their support is so strong unless something heavier comes in. It's like life, right? I have a pretty strong head, I guess, or you have a pretty strong home with a pretty strong roof. Odds are, normal everyday life, if we're just going through the routines of life, nothing is going to happen. But what happens if a tornado shows up? If the strength of the force is more than that roof, it's either going to collapse that roof or put holes in it. It's going to make it weaker and weaker. So with that said, we're building supports as we're building these positions, right? So one support level, another support level, another support level, another support level, and the position's getting stronger and stronger and stronger. What happens is, as that trading desk profits, what it wants to do is it then wants to sell. They want to sell, right? So their position goes up in value. They built these steps, call it 10, 15 steps. Those are what we refer to as support levels. Okay. Those support levels are built. Now they want to sell that stock because their job is to profit. The only way to profit from a security is to sell it. Otherwise, it's just on paper. So you can own ABC stock at $10 and now it's worth $1,000, but it's not actually a gain in any sense until you sell it. So they have to sell it. Who do they sell it to? They sell it to the retail investor. Now, what happens is they have built these steps piece by piece by piece by piece, taking their time. Why? They don't want to get retail investors. They don't want to get the average person excited. They don't want you excited yet. They need to build their position up. So they build it slow, very slowly. They take their time building it so it's not noticed, so it goes unnoticed. That's the point in a slow rising market. The point in a slow rising market is not to get individual investors' attention. You got to take it easy. When you want their attention and you want to get them emotionally charged, that is when you start your big purchases, your big moves. Now you'll start to see price go zum, zum, zum. And there's much, much bigger gaps in those steps because price is rising very quickly. There's a term used for when prices rise very quickly in any security, and that term is parabolic. You've gone parabolic. And that's when prices start to skyrocket. Now, why are prices skyrocketing? To get you emotional, to get the average investor emotional. That is the point. You're meant to be emotional because you're going to start buying. Why? You're afraid you're missing out. All this money is being made, and you have no part in it. And I knew I should have bought ABC. I saw when it came out 2 years ago, and I knew it was going to be a great company. I'll tell you how I knew. And everybody has their like reason on how they knew this was going to be so great. But then I didn't buy, I know I should have. And all of a sudden people start buying and they start piling in. Woohoo, we're making money. And that's the exact point of going parabolic, having a rising price, is that right there. That's why it's happening. That is the point of why it's happening. And guess what? As you buy, they start selling. But because they now have your attention and price is moving so quickly, they get to sell pretty quickly. And guess what happens then? Every time they sell, they're removing another step. They're removing another piece of support. So guess what happens? We already had wider gaps as they move prices up very quickly. Now they've pulled out those supports and prices nosedive. That's why, even though bear markets only take 20% of the time, they take most of the gains back of a bull market. Bull market is a rising market. Bear market's a falling market. And that is why bear markets are so fast and bull markets are so slow. They're fast, and it's not like it's this design, although it is. It's just a structure. You're removing the support. You're removing the steps. So prices fall, and they fall quickly. And most people give back most of those gains that they just made. And then typically you're buying a little late, so you're going to give more than you gained, and that creates another emotion. That creates the emotion of, oh no, what did I do? And this is the emotion of a rising market and a falling market. The reason a rising market takes so long is literally the structure, and they don't have your attention. You're not emotionally engaged yet. A rising market doesn't really have that much emotional engagement until it's meant to. When it's meant to, prices will move up very fast, and there'll be a lot of trading activity. And that indicates to you that your emotions are being manipulated. If you're aware of the fact that your emotions are being manipulated, you won't buy into it. You'll wait until prices come down, and then those people that had their emotions manipulated at the top, they'll be selling at the bottom, and guess who will be buying? That center structure. Your brokerages, your banks, your hedge funds, your CTAs, now they're buying. They're buying it back from you. They sold it to you high, and they're buying back low. That's why they're so profitable. You have to understand that. There's a reason they're as profitable as they are. It's not because they buy high and sell low. It's because they buy low and sell high. And who are the buyers? Retail investors, the average everyday guy. As soon as they're excited, boom, sell it to them. They're excited. And the media helps with that excitement. But that structure, that market, you have to understand there's a market structure to it. If you understand that structure, then you have the ability to avoid the mistakes. If you can avoid the mistakes, if you can know the average mistake made and you avoid it, you can then capitalize on it. So while everyone else is excited, you're not. When everyone else starts to get miserable, you're excited. It's like the old saying, I buy when there's blood in the streets. That's what they're referring to. They're referring to the fact that intelligent investors aren't buying at highs when people are excited and they feel good about things. They're buying when people are extremely depressed. That's why it's so important not just for an investor in stocks or bonds or currencies to understand this stuff. If you're a small business owner, if you're an entrepreneur and you don't realize, if you don't understand how this stuff works, you're at an incredible disadvantage. I can tell you that I helped build out a small business in Los Angeles. It was a martial arts business in Los Angeles during COVID, when everybody else was terrified, we were doing a huge build out, right? We did a huge renovation. We went from we doubled the square footage of the place that we were in. We have tripled the revenue inside of 3 years. While I was building it, everybody said, "You're crazy. You're going to lose. This will never work." But I could see by looking at markets how to judge the economy. I could see that the people that were actually scared were just the retail, right? Just us, just the normal people. We were afraid. I can tell you, on a global scale, there was no one in the know that was actually afraid. And I can show that to anybody that would like to take a look. So listen, I'm going to end this here. I've been on for 15, 20 minutes, I guess, at this point. But what I would like to say is, look, I love doing these broadcasts and I really enjoy talking about this stuff. If you enjoy it and if it feels good to you, please go to my website, which is www.prometheaninvesting.com. You can donate there. I also have courses that you're able to purchase. For those of you that are watching me on TikTok, this won't come up for you. For those of you that are on my streaming, whether it's LinkedIn or Facebook or Twitter, who else do I have? Instagram. I'm going to put up, I have courses. I have a VIP membership course starting. It's a 6-week course. I'm going to put that up now. If you're on Twitter, you'll see it at the top of my page. If you're not and you're tuning in from one of the other channels, you'll see it up now. That VIP mentorship course is 6 weeks long. I do a live session each week. I show you how to identify these points of inflection in markets, how to read those points of inflections, and how to profit from them by simply avoiding when others are getting excited. How do you identify those footprints? Okay. What is the actual market structure? And then how do you profit from it? As a small business owner, as an investor, how do you make money from these things? That VIP mentorship, I cut the price in half. It's a Mother's Day special. It's just under $500 right now. I go live once a week for about an hour, and we go through coursework together. Then I do a 2-hour Q&A session each week. Both of those are recorded in case you can't make it. And I also send out notes to everybody on every session so that you're able to keep up. This is an amazing course and an amazing price. So if you would like to do that, that is my preferred methodology. But I also have 2 other courses that I can throw up on there. One is a course on financial planning and basic investment, so asset allocation models. It'll also show you how to set up an account. It'll show you how to make a trade if that's where you're at currently. I'm going to leave up that VIP mentorship code for now, but you can also just simply go to my website. If you have any questions or comments, please ask below. Like the video, share the channel. I know some of you are on YouTube as well. Feel free to follow me, subscribe. I appreciate everybody being here. I hope you really enjoyed it. I'm going to put up this recording here very shortly. It'll go on to all my channels. I hope you learned something. Again, if you enjoyed this, feel free to go to my website and you can donate, www.prometheaninvesting.com. Otherwise, I do have courses available for you. Thanks for joining me. And we'll see you again here real soon.